Welcome to the Holistic Accountant Podcast. The aim of this podcast is to demonstrate how accountants must employ a holistic approach to help their clients maximise wealth. It's not just about preparing tax returns. So each week, Mena and I will discuss topics to help you better understand some of the things your holistic accountant can help you with. When we borrow to invest in property, often the interest costs and all the expenses associated with that investment property are greater than the rental income that we receive, so we make a income loss each year. And thankfully, we can offset that income loss against other taxable income to reduce the total amount of tax that we pay in any particular financial year. That is referred to as negative gearing or a negative gearing tax benefit. And today we're going to talk about how to maximise those tax benefits if you're investing in property. So Mena, over to you.
Well, when it comes to negative gearing, interest is your biggest deduction. Now, when it comes to interest, it's incredibly important to know how to structure not only the loans themselves, but the purchase. So that comes down to joint tenants or tenants in common. So, for example, if you're at the highest marginal tax rate and your partner is not working or at a much lower tax rate, generally, you would want to have the property more weighted in your name, if not 100% in your name, to enjoy the greatest benefits of the negative gearing. Now, also, you don't want to mix purposes when it comes to loans, so you want to borrow as much as possible. Now, that could mean drawing on equity from an existing property. We generally wouldn't use cash in offset from a principal place of residence. We would want to draw on the equity of the existing property to purchase the investment property, because that will give you the biggest interest deduction.
Yeah, so interest is your biggest tax deduction, so don't compromise it. And remember, the onus is on the taxpayer to prove the deduction. The ATO doesn't have to disprove it, right? So, which means that the ATO can just go, well, we'll just decline the deduction unless you can come to us with lots of proof of why it is actually deductible to you. So that means that you've got a lot of onus on you to make sure that you've structured your affairs in a way that you can easily prove and demonstrate to the ATO, even up to 5 years' time, for example, if they come back to you, that you've got a legitimate tax deduction there. Getting advice in regards to how to own the property is really important as well, because it can be cost prohibitive to change ownership at a later date. Typically, that would trigger capital gains tax and possibly even stamp duty as well. So they're two very big costs. So often, once you've purchased a property, you've got to live with that ownership structure really for the entire time you own that property. So you've got to think really carefully about that.
Now, there are other deductions such as your insurance, your depreciation, your rates, and so forth, but they're just general deductions, and if your accountant's missing out on those, then they really shouldn't be your accountant, should they, Stuart?
No, that's right. Look, sometimes we say to clients, look, if you're operating a pharmaceutical business, for example, pharmacy business, go and get an accountant that is a specialist in that area, or a dental surgery or whatever it might be. You don't really need to find a accountant that's a specialist in investment properties, because most accountants will have clients that invest in property, and that's really their bread and butter. It should be some really basic stuff. So if they're not doing the basic stuff well, it's sometimes it's a sign that you need to move on and find yourself a new accountant. It's great to maximise tax benefits, of course, and minimise overall tax. And investing in property or borrowing to invest in property will help you do that. But it's a consequence. It's a positive consequence of investing in property. It's not the reason for it. So the reason that we invest in property is to build wealth. If we can save a little bit of tax along the way, that's fantastic. But really, it's about making sure that our property is delivering good quality returns. So that is both a good rental income, and if it's not a good rental income, hopefully then you're compensated by a lot of capital growth. But if you're not getting much in the way of capital growth or rental income, then there's no real point saving tax. I mean, you could donate all your money to charity and that would save a lot of tax as well. A nice thing to do, but doesn't make you independently wealthy. So sometimes we can be a bit too tax focused, I think. I mean, we've got to try and, the whole point is if you're going to buy an investment property, absolutely minimise tax. but really it's really about building wealth on an after-tax basis, and saving tax is only one component of that. Thank you for listening to the Holistic Accountant podcast. To find out more, please visit holisticaccountant.com.au.